If you're looking to build wealth without clocking into a job or managing a side hustle every day, you're in the right place. Today, we're diving into the top 4 investments that generate true passive income. Money that makes itself while you sleep. Whether you're trying to escape the 9 to 5, diversify your portfolio, or build long-term financial security, this is the video you need. So grab a notebook and make sure to stay to the end because we're going deep, and I'm even ranking these investments based on risk and reward. Let's get into it. Number 1, dividend paying stocks. Dividend paying stocks are a classic way to generate passive income. These are shares of companies that pay out part of your profits to shareholders, usually every quarter. Think of big stable companies like McDonald's, Johnson & Johnson, or Procter & Gamble. These are known as dividend aristocrats, companies that have increased their dividends for 25 years or more. So how does this work in your favor? If you own 100 shares of a company that pays $1 quarter dividend, you earn $100 every quarter. And here's the kicker. If you reinvest that dividend to buy even more shares, you compound your earnings over time. It's a snowball effect that grows your passive income without you doing anything else. To get started, you can use platforms like Fidelity, Charles Schwab, or even Moomoo, which sometimes offers promotions like free stocks. Just make sure you research the financial health of the companies you invest in and aim for those with a solid track record of paying and increasing dividends. All right, number 2, real estate investment trusts, or REITs for short. Don't want to manage tenants or fix toilets? REITs are your best friend. REITs are companies that invest in income-producing real estate. Think shopping malls, apartment buildings, hospitals, and data centers. And by law, REITs must pay at least 90% of their taxable income as dividends. That's why REITs often come with some of the highest dividend yields in the market. Examples include Realty Income, also known as the Monthly Dividend Company, or the Vanguard Real Estate ETF VNQ, which offers broad exposure to the real estate sector. REITs are great because they're easy to buy and sell on stock exchanges, just like any stock. And you don't need a huge amount of money to start. You could begin with as little as $50 or $100 and build from there. But remember, REITs can be sensitive to interest rate changes, so be sure to diversify within the category commercial, residential, industrial to reduce your risk. All right, number 3, fixed income securities. Bonds. If you're more risk averse or getting closer to retirement, bonds are a solid option. When you buy a bond, you're basically lending money to a government or corporation. In return, you get regular interest payments and your principal back at maturity. Right now in 2025, a 10-year US Treasury bond are yielding about 4.21%, which is very respectable considering the low risk. That means if you invest $10,000, you can expect about $421 per year in passive income paid semi-annually. There are several types of bonds to consider. US Treasury bonds, very low risk, highly liquid. Municipal bonds, often tax-free, ideal for high-income earners. Corporate bonds, higher yields, but also higher risk. For even more convenience, look at bond ETFs, like the iShares Core US Aggregate Bond ETF, in short AGG, which gives you diversified bond exposure with just one purchase. Bonds may not give you interest, but they offer stability and predictable income, especially useful when markets get choppy. Number 4, dividend-focused exchange-traded funds, or ETFs for short. Want exposure to dozens of dividend-paying stocks without picking them one by one? There's where dividend ETFs come in. These funds invest in a basket of companies known for paying high dividends. They're professionally managed and come with lower fees than mutual funds. Some top options include Vanguard High Dividend Yield ETF, VYM, Schwab US Dividend Equity ETF, SCHD, Franklin US Low Volatility High Dividend ETF, LVHD. What's great about dividend ETFs is that they give you diversification and reliability. If one company cuts its dividend, other in the ETF can help balance it out. These ETFs often yield around 3 to 5% depending on the fund and market conditions. And yes, and just like with dividend paying stocks, you can reinvest dividends for compounding growth. Platforms like Vanguard and Charles Schwab make it easy to automate this process. Here's how to build your passive income portfolio. Now, let's put this all together. If you had $100,000 to invest and wanted to build a balanced passive income portfolio, it might look something like this. $30,000 in dividend stocks, $25,000 in REITs, $25,000 in bonds, and $20,000 in dividend ETFs. This kind of gives you a mix of growth, income, and stability. Your annual passive income, roughly $4,000 to $6,000 depending on your exact yield and asset choice. Even if you're starting with just a few $100, the key is consistency. Contribute monthly, reinvest your dividends, and watch your income grow. Now, here are some common mistakes to avoid. Let's talk about some traps you want to stay clear of. The first is chasing high yields. Just because a stock or REIT offers a 10% yield doesn't mean it's sustainable. It could signal financial trouble. There could also be a lack of diversification. Putting all your money in one stock or one sector increases risk. Spread it out. Another is ignoring tax implications. Some dividends are taxed as ordinary income, others are qualified for lower rates. Use tax advantage accounts like IRAs when possible, not reinvesting. If you're not living off the income yet, reinvest everything to grow your portfolio faster. Here are some platforms that make it easy. You don't need to be a Wall Street pro to get started. Here are a few platforms that are beginner friendly. Fidelity, known for zero commission trading and great customer service. Moomoo offers promotional stocks and tools. Vanguard, great for ETFs, super low expense ratios. Fundrise, for fractional investing in real estate. If you prefer alternatives to REITs, most of these platforms also offer automatic reinvestment features and easy portfolio tracking.